Have you ever heard the phrase, paper gold isn't real gold? It gets thrown around a lot, especially in precious metal circles. But what does it actually mean? And is there any truth to the rumor that a big change in banking rules, specifically something called Basel III, is about to send the price of gold and silver to the moon? Today, we're going deep. We're going to unravel the complex world of paper gold, dissect the Basel III regulations, and separate the hard facts from the wild speculation. This isn't about hype. It's about understanding the real mechanics of the global financial system and what it means for your money. So grab a coffee, get comfortable, because this is a masterclass in how gold truly works. Let's start with the heart of the matter, Basel III. It sounds like something out of a spy movie, but it's actually a set of international banking regulations. To really get it, we need to travel back in time. After World War II, the global financial system was rebuilt, and banks grew larger and more interconnected than ever before. But with that growth came new risks. The 1970s and 80s saw a series of banking crises that made regulators nervous. So, in 1988, a group of central bankers met in Basel, Switzerland, and created the first Basel Accord, or Basel I. It was a simple idea. Banks had to hold a certain amount of capital as a buffer against their risky loans. Think of it like a driver needing a certain amount of tread on their tires. The riskier the road, the more tread you need. But Basel I was too simple. It treated all loans as equally risky, which wasn't realistic. So in 2004, we got Basel II. This was much more sophisticated, allowing banks to use their own internal models to assess risk. The problem? Banks, being banks, found ways to game the system. They underestimated risks to minimize the capital they had to hold, freeing up more money for profitable but dangerous bets. And then came 2008. The global financial crisis hit, and it became terrifyingly clear that Basel II wasn't enough. Banks that looked perfectly healthy on paper were actually teetering on the brink of collapse, loaded with toxic assets. The whole system nearly went down. That catastrophe was the catalyst for Basel III. It was a massive overhaul, a desperate attempt to make the banking system safer. The goal was to force banks to hold more capital, and not just any capital, but higher quality capital, the kind that can actually absorb losses in a crisis. The rules also introduced new safeguards, like stress tests, and crucially for our story, 2 new liquidity ratios, the liquidity coverage ratio, or LCR, and the net stable funding ratio, or NSFR. The LCR ensures a bank can survive a 30-day market panic. But it's the NSFR that really got the gold community talking. The NSFR is all about long-term stability. It requires banks to have enough stable, long-term funding to back their long-term assets. Think of it like building a house. You can't build a skyscraper on a foundation of sand. The NSFR says your funding source, the money you use to make loans and investments, has to be as stable and long-term as the assets themselves. For example, a 30-year mortgage needs to be funded by something more reliable than overnight loans from other banks. It needs to be backed by things like customer deposits or long-term bonds. This prevents a situation where a bank's short-term funding dries up, forcing it to sell its long-term assets at fire sale prices, triggering a collapse. So where does gold fit into all this? Under the old rules, gold was treated pretty harshly. It was considered a Tier 3 asset, and banks could only count 50% of its market value towards their capital requirements. It was seen as just another commodity. But under the new Basel III framework, something changed. Physical, allocated gold that a bank holds in its own vault, owned outright, was reclassified. It's now considered a Tier 1 asset. This is the highest quality asset class, right up there with cash and central bank reserves. And here's the key part. It gets 100% risk weighting. This means a bank can count the full market value of its physical gold towards its capital buffers. It's treated as a zero-risk, perfectly liquid asset, equivalent to cash. This is where the excitement and the misinformation began. The theory goes like this. If physical gold is now a top-tier, zero-risk asset, but paper gold is not, then banks will be forced to dump their risky paper gold contracts and scramble to buy real physical metal to meet the new NSFR requirements. This massive shift from paper to physical would create a supply squeeze of epic proportions, causing the price of gold to skyrocket. Some commentators were predicting gold would go to $10,000, $20,000 an ounce, almost overnight. It was a compelling story. It sounded logical. The only problem is, it's a fundamental misunderstanding of how these rules actually work. To see why, we need to understand the beast that is paper gold. It's not one single thing. It's a vast, complex ecosystem of financial instruments that give you exposure to the price of gold without you ever touching a single ounce. The biggest players in this world are the London Bullion Market Association, or LBMA, and the COMEX Futures Exchange in New York. The LBMA is the center of the global over-the-counter gold trade. We're talking about transactions between major banks, dealers, and institutions. It's a wholesale market, and the volume is staggering. Trillions of dollars worth of gold traded each year. But here's the kicker. The vast majority of this trade is in unallocated accounts. What's an unallocated account? It's essentially an IOU for gold. When you have an unallocated account with a bank, you don't own specific numbered gold bars. Instead, the bank owes you a certain amount of gold. You are a creditor to the bank. The bank, in turn, holds a pool of gold to back all its unallocated accounts. But crucially, it doesn't hold 1 ounce for every ounce it owes. It operates on a fractional reserve basis, just like with cash deposits. They know that not everyone will ask for their physical gold at the same time, so they can use that unclaimed gold for other purposes, lending it out, leasing it, or using it as collateral. This is how the paper gold leverage is created. For every 1 physical ounce of gold in the London vaults, there could be 10, 50, or even 100 ounces of paper claims against it. No one knows the exact ratio, and that's part of the problem. The system is efficient. It allows for massive trading volumes with minimal physical movement, keeping costs down, but it carries a huge risk, counterparty risk. What happens if the bank you hold your unallocated account with goes bust? Well, you get in line with all the other unsecured creditors and hope to get some of your money back. You don't own the gold, the bank does. History is littered with examples. In the 1980s, a major bullion dealer in the US collapsed, and clients with unallocated accounts lost everything. More recently, during the 2008 crisis, the fragility of these IOUs became terrifyingly apparent. Then you have the COMEX, the primary market for gold futures. A futures contract is an agreement to buy or sell a specific amount of gold at a predetermined price on a future date. Most people who trade futures have no intention of ever taking delivery of the physical metal. They are speculators, hedging or betting on price movements. They close out their position before the contract expires. Less than 1% of COMEX gold contracts are ever settled with physical delivery. It is overwhelmingly a paper market, a place for price discovery and speculation, driven by leverage. You can control a 100-ounce gold contract, worth nearly $200,000, for a fraction of that margin. This leverage magnifies both gains and losses and adds another massive layer to the paper gold pyramid. So we have this enormous, highly leveraged paper market sitting on top of a relatively small base of physical gold. Now, let's bring it back to Basel III and the NSFR. The big theory was that the NSFR would make holding unallocated gold positions incredibly punitive for banks. Why? Because an unallocated gold position is a liability for the bank. They owe gold to a client. But it's also an asset. The client's claim is something the bank uses. The rumor was that these unallocated positions would get a terrible rating under the NSFR, making them very expensive for banks to hold. Specifically, the claim was that they would require an 85% required stable funding factor. This would mean a bank would have to secure 85 cents of stable, long-term funding for every dollar of unallocated gold on its books. That's a huge cost. If this were true, it would indeed be a game changer. Banks would have a massive incentive to close out these paper positions. They could either force clients to convert their unallocated accounts into allocated ones, where the client owns specific, segregated bars, or they could buy physical gold on the open market to cover their paper shorts. Either way, it would lead to a monumental demand for physical metal. This was the Basel III rocket fuel theory. But here's the crucial detail that the hype train missed. The rules apply to the bank's balance sheets. Unallocated gold accounts are a prime example of what's called a clearing and settlement activity. Banks act as intermediaries, matching buyers and sellers. The Basel Committee recognized that applying a punitive 85% factor to these activities would grind the entire market to a halt. It would be like making a highway toll so expensive that no one drives on it anymore. So they created specific exemptions. Deep within the Basel III documents, it clarifies that for precious metals clearing activities, if the transactions are matched, meaning for every client liability there's a corresponding asset, and the bank is just an intermediary, then these positions are treated differently. The residual positions are what matter, and these can be netted. The result is that the actual impact of the NSFR on the big bullion banks' unallocated gold businesses is minimal. It is not zero, but it is nowhere near the cataclysmic 85% cost that was being promoted. The banks had years to prepare for this. They restructured, optimized, and found ways to comply without blowing up their business model. There was no mad scramble. There was no sudden dumping of paper for physical. The evidence is clear. The NSFR rules were implemented for European banks in June 2021 and for UK banks, where the LBMA is based, on January 1st, 2022. What happened to the price of gold? Nothing. There was no explosion, no moonshot. The market yawned. The doomsday scenario, the great paper-to-physical migration, simply didn't happen because it was based on a flawed reading of the regulations. The idea that a group of banking regulators would intentionally, or even accidentally, create a rule that would detonate the multi-trillion-dollar precious metals market overnight is, frankly, not very plausible. These institutions move slowly and deliberately, and their primary goal is stability, not disruption. So does this mean it's all over for gold and silver? Absolutely not. It just means that Basel III wasn't the magic bullet some people thought it was. The real reasons to be bullish on precious metals are far more fundamental and enduring. The reclassification of physical gold as a Tier 1, zero-risk asset is still incredibly significant. It is an official, global acknowledgement from the highest levels of the financial system that physical gold is ultimate money. It's a recognition that in a world of exploding debt and endless money printing, gold is a uniquely stable and reliable store of value. It's a fire extinguisher in a world full of arsonists. Central banks certainly get it. For the past decade, they have been buying physical gold at a historic pace. Countries like China, Russia, Turkey, and India are repatriating their gold from vaults in London and New York and adding to their reserves. Why? Because they are diversifying away from the US dollar. They see the weaponization of the dollar through sanctions and the erosion of its value through inflation, and they are seeking financial independence. Gold is not controlled by any single government. It cannot be printed into oblivion. It is the ultimate neutral reserve asset. This institutional demand is a slow, powerful, and undeniable trend that will provide a strong floor for the gold price for years to come. And what about the individual investor? The reasons to own physical gold have never been stronger. We are living in an era of unprecedented monetary experimentation. Quantitative easing, zero and negative interest rates, and now staggering levels of government debt taken on in recent years. Every dollar, euro, or yen in your bank account is a claim on a system that is fundamentally indebted and unstable. That currency is losing purchasing power every single day due to inflation. Physical gold and silver are the opposite. They are finite assets with no counterparty risk. An ounce of gold in your hand is not someone else's liability. It cannot go bankrupt. It cannot be defaulted on. It has been a store of value for 5,000 years, through the rise and fall of countless empires and their fiat currencies. Now, let's talk about silver, gold's more volatile sibling. Silver has a fascinating dual personality. For millennia, it was money, circulating as coinage far more widely than gold ever did. It still retains that monetary aspect. When people lose faith in paper currency, they often turn to both gold and silver, but silver also has a massive and growing industrial demand. It is the most electrically conductive and thermally conductive metal on the planet. This makes it indispensable in modern technology. It's in your smartphone, your laptop, your television. But the real story for silver's future lies in the green energy transition. Solar panels are a huge consumer of silver. An average photovoltaic cell uses a significant amount of silver paste to conduct the electricity generated. As the world races to build out solar capacity to meet climate goals, the demand for silver is set to explode. The same is true for electric vehicles. EVs contain significantly more silver than traditional internal combustion engine cars, used in everything from battery connections to electronic components. So, while gold is primarily a monetary asset, silver has this powerful dual demand driver. It's both a safe haven asset and a critical industrial commodity with no easy substitutes. This creates a potentially explosive setup. The silver market is much smaller than the gold market, meaning that a relatively small influx of investment capital can have a much larger impact on its price. For years, the price of silver has been suppressed, trading at a historically high ratio relative to gold. But as industrial demand continues to chew through available supply, and as more investors wake up to its monetary properties, that dynamic could shift dramatically. Many analysts believe silver is one of the most undervalued assets on the planet right now. So, what are the key takeaways from all of this? First, be skeptical of hype. The Basel III story was a classic example of a complex topic being oversimplified to create an exciting but misleading narrative. Always do your own research and look for the boring, nuanced details, because that's where the truth usually lies. Second, understand the difference between owning real physical metal and owning a paper promise. Unallocated accounts and futures contracts have their place, but they come with counterparty risks that physical gold and silver do not. If your goal is wealth preservation and insurance against systemic risk, physical is the only way to go. Third, and most importantly, the long-term case for gold and silver remains incredibly strong, but it has nothing to do with a misinterpretation of banking regulations. It has everything to do with the big picture: unsustainable government debt, persistent inflation, geopolitical instability, and a global trend of de-dollarization led by central banks. These are not short-term trades, they are long-term secular trends that will unfold over years and decades. Owning physical precious metals is not about getting rich quick. It's about preserving the wealth you have, It's a vote for financial prudence in an imprudent world. It's your personal financial insurance policy. So don't be swayed by the latest rumor or prediction of a price explosion. Instead, focus on the fundamentals. Accumulate physical metal steadily and consistently, and you'll be well prepared for whatever the future holds. Thanks for watching, and I'll see you in the next video.